if you want to become a smart, confident, and long-term investor. There's one book that stands above all. The Intelligent Investor by Benjamin Graham, the mentor of Warren Buffett, who calls this book by far the best book on investing ever written. In this video, we'll break down the core lessons of the intelligent investor in a simple and practical way, so you can understand how to build wealth patiently, wisely, and safely. Let's begin. Part 1. Who is the intelligent investor? First, Graham doesn't define an intelligent investor by IQ or education. He says, the intelligent investor is a realist who sells to optimists and buys from pessimists. It's about having the right temperament, not talent. It's about being disciplined, patient, and rational, especially when markets are not. Part 2. Two types of investors. Graham divides investors into two categories. Defensive, passive investor wants minimal effort and risk. Follows safe, slow, and steady strategies. Focuses on index funds or blue-chip stocks. Enterprising, active investor willing to study the market in depth. Seeks undervalued stocks. Spends more time analyzing companies. Choose your style, but stick to it with discipline. Part 3. The concept of margin of safety. This is the core idea of the entire book. Margin of safety means always invest with a cushion. If a stock is worth $100, but you buy it at $70, you have a $30 margin in case things go wrong. This protects you from unexpected downturns, errors in judgment, or market panic. Great investors don't chase profits. They avoid losses. Part 4. Mr. Market Metaphor. Graham introduces a powerful metaphor, Mr. Market. Imagine the stock market as a person. Every day, Mr. Market offers to buy or sell stocks at different prices. Sometimes is excited, sometimes depressed. Your job is not to follow Mr. Market. Your job is to stay calm and only act when the price is right. Be independent in your thinking. Markets are there to serve you, not to guide you. Part 5. Speculation versus investment. Graham makes a sharp distinction between investment, based on analysis, safety of capital, and reasonable return. Speculation, based on guessing, hype, or emotion. Speculating isn't always wrong, but it's dangerous if you don't know you're doing it. Smart investors respect risk and know the difference. Part 6. Principles for defensive investors. For passive investors, Graham suggests a balanced and boring approach. Diversification. Spread your money across 20 to 30 high-quality stocks. Bonds plus stocks mix. Keep a 50-50 as mix of stocks and bonds, adjust slightly based on market conditions. Avoid hype. Never follow trends or tips blindly. Dollar-cost averaging. Invest the same amount regularly, regardless of market highs or lows. In short, stay consistent and keep it simple. Part 7. Principles for enterprising investors. If you want to be an active investor, Graham says, do deep research on companies. Look for undervalued stocks with strong fundamentals. Study financial reports, earnings history, debt levels, and management quality. Use simple metrics POE ratio, book value, and dividend yield. Never chase hot stocks or market trends. Patience plus discipline equals long-term gains. Part 8. Emotional control and investor psychology. One of the biggest threats to your portfolio isn't the market. It's your own emotions. Greed, fear, overconfidence, panic. These cause bad decisions. The intelligent investor remains rational in both bull and bear markets. The investor's chief problem, and even his worst enemy, is likely to be himself. Train your emotions, and your investments will follow. Part 9. Key takeaways in Buffett's advice. Warren Buffett read this book at age 19 and said it changed his life. Here are the top 5 takeaways. Always invest with a margin of safety. Treat the market like Mr. Market, not your master. Focus on the intrinsic value, not short-term prices. Be clear whether you're investing or speculating. Master your emotions, not the market. Investing is not about brilliance. It's about behavior. If you want to build real wealth, not just get rich quick. The intelligent investor is your lifelong guide. Start small. Be consistent. Think long-term. If you enjoyed this video, give it a thumbs up, subscribe, and tell us in the comments, which book should we summarize next? Until next time, Invest smart. Stay calm. Keep learning.